Okay, welcome to a quick look at calculating depreciation. Depreciation is a loss on the value on our non-current assets. A few things to go through at the start. PA means per annum, which means per year. So we will usually use that notation. The word cost is a key term that basically means the original purchase price of an asset, so what you paid for it when you bought it. And what you paid for an asset when you bought it is always going to be the same number. So the cost always stays as the same number. Cost minus the total loss in the value, so whatever you paid for it minus what it's lost in value, gives us something called the net book value, or NBV, the current value in our accounting financial statements, in our books. Okay, so that's just some key terms. There's three main methods. Number one, straight line method of calculating depreciation, calculating the yearly loss in the value of non-current assets. If we were using this, if the company or business decides to use this as a policy of depreciating their assets, we would work out the percentage. So the percentage in this case, in our example, is 20%, but it could be it could be 10 or 15% or 25%, whatever the business decides. And then if that's the case, if we're using straight line, we would do the percentage, in this case 20%, on the cost of the asset, which is the original purchase price, which never changes. If we were doing a diminishing value method or reducing value method, then we would do the percentage, whatever that percentage is decided to be. In this case, we're going to use 20% as an example, but it could be 10 or 15 or 25 or 5% even. We're going to do that percentage, work it out on the net book value to work out the yearly depreciation cost. And that would go in the income statement or statement of profit and loss. And then the third method is when we use this formula, and there'll be some ideas of when we use it, such as you'll be given a residual value. Residual value is the expected value at the end of ownership. And useful life is the number of years you expect to own it, and we already know what cost is. So let's have a quick look at example number one when we're doing straight line method. Amy buys a machine for 100,000, so we could say that's the cost or original purchase price. That figure's never going to change. The cost is never going to change. And if we're doing 20% per annum depreciation, that means for ownership for a year, and we're doing straight line, that means we work out the 20% on this value, which is the original cost. So that 20% of that is 20,000. So that is going to be our yearly depreciation cost. The loss in the value of our assets is an expense. It goes in the income statement or statement of profit and loss. And in year two, when we're working out this depreciation on the same asset, we still have straight line method. We're still using that as a policy. Obviously, the company or business can decide which method or policy to use. And if they're still using 20%, then 20% straight line method means that we're doing the 20% on the cost. The cost is still 100, so 20% of that cost is again 20,000. So in year two, the cost of depreciation, which goes in the statement of profit and loss or the income statement as an expense, is 20,000 again. If we were doing diminishing value or reducing value method, we would do the percentage, whatever it is. In this case, we're going to assume the same 20% depreciation. It could be 10 or 15 or any percentage decided by the business, but I'm using 20% so you can see the difference between the two. So 20% of the asset, and assuming that we buy it for 100,000, the cost is 100, 20% of 100 is 20,000. And that will be year one depreciation cost. And that will go in our statement of profit and loss or income statement as the depreciation expense for that year. Then in year two, now, so remember we're doing the percentage on the net book value. We've got to now find out what the value of that asset is after it has depreciated. In year one, because the net book value is the cost minus the total depreciation. So far, the total depreciation on this asset is 20. So the cost minus the depreciation of 20 means that the net book value now is 80. Now remember, if we're using this, we're working out the depreciation on the net book value for year two. So in year two, when we're working out the depreciation, we've got to do it on the net book value at that time. And at that time, obviously at the end of year one, the value is 80, so that's the value we take. So 20% we're going to do of 80,000 to work out the depreciation in that second year, which is obviously 80,000 is the new value. 20% of 80,000 is 16,000. So 16,000 is the loss on the value of non-current assets, which is the expense that goes into the statement of profit and loss for year two or the income statement. And so that is there. So now if you complete these figures, 100,000 is still the cost. The total depreciation now is 36,000. Taking year 1 and year 2, the total depreciation 36. If we took that away, remember, to work out the net book value is the cost minus total depreciation. Cost minus total depreciation, that means that the net book value now is 64,000. So now to work out the depreciation in year 3, we are still using diminishing value or reducing balance method, which means we work out the percentage on the net book value. At this moment, the net book value is 64,000. So if we're doing 20% of the 64,000, that's 12,800 depreciation. So in year 3, 12,800 will be the depreciation loss or expense in the statement of profit and loss or income statement. That's an expense. And then obviously we can fill that in for the remaining value after that. But these are the figures that go into the income statement or statement of profit and loss, whatever you choose to call it. If we were using the formula, then we have these figures. So the cost being 100,000, we expect to keep the asset for 4 years. So the cost being 100,000, we expect to keep the asset for 4 years, and we expect it to be worth 60,000 at the end of those 4 years. So if we work this out, that's a loss of 40,000, and that's spread over 4 years. So the yearly loss or depreciation expense is 10,000 per annum. Now, this is going to be the same no matter which year you work it out in. So the income statement or statement of profit and loss depreciation expense figure in all those years will be that 10,000 cost. Remember, this formula gives us the yearly depreciation cost, and that's 10,000 in that case. Now, hopefully that was useful. What we've done here is calculating the depreciation figure that goes into the income statement, and also you could say how we value the remaining value, net book value of our assets in the statement of financial position for the non-current assets. But then there's going to be a separate video for accounting for depreciation, how we do the double entry for it.